Andy, let's begin with you, sir. Your thoughts on that, the threshold to bring the Fed back to the table in 2020?
I think if we put to one side what happened overnight, because I think that's much more complex and the reaction from Iran will be important. Otherwise, I don't think the Fed's going to be back to the table anytime soon. And I think the same can be said of basically all central banks in the G7. If you look at the pricing, no one's expecting anything from anyone. I think we're in a very benign period, absent any further escalation in the geopolitical issues.
Let's bring the conversation around the table here in New York. Diana, is that your take as well?
I think for now, for the first half of the year, we're likely to see the Fed remain on hold. I think into the second half of the year, we could see them come back to play, especially because we don't see too much of a follow-through on growth in the U.S. and we expect inflation pressures to remain quite contained.
What's your take, Greg?
Yeah, I think consensus is right, where the Fed is very much on hold, but a year is a long time, and so a lot can change, and so we learned that just overnight. So I think the base case is right, but I think it's important always to kind of retest that base case and not get too comfortable with it.
There is just a view that the Fed's view of the economy has shifted. They see more slack in the labour market in a way that maybe they didn't before. And the reaction function has shifted. The way they will respond to incoming data is responding to that has shifted too. How big has that change been in the last 12 months for you, Greg? How key is that?
Well, you just look at the dot plot, right? It's been pretty dramatic. And so that really tells you how their minds have shifted. But I still think they're surprised by the lack of inflation, right? So the labor market is still tight, not as tight as they thought, perhaps. But you're not seeing the inflation that I think everyone at the Fed expected. And I think as a result, they'll continue to run this experiment a little hot.
Do you expect to see it anytime soon?
No, not really. I mean, it's firming. It's come off the bottom, but do have a big uptick in inflation? I really don't see it.
Diana, is that your take too?
We think inflation will get to 2 this year and will remain somewhere close to that. But I think the Fed will want to let it stay at that level until inflation expectations re-rate meaningfully. So this shift towards average inflation targeting, this is the year it's happening. So I think that's what they'll be putting to play.
Do these ideas resonate with you, Andy?
Yeah, I think Diana's spot on when it comes to inflation. If you do get an uptick in inflation, they'll let it ride. I think people's expectations have become so benign in recent years that inflation is not really the problem. They're focusing on growth or any challenge to the growth outlook. So their focus is more on the other side, I think, than hiking rates to defend against inflation, because they kind of know they can control that side of the equation.
Well, let's talk about rates, Andy. Does that keep a lid on 10-year Treasury yields in and around 2% and lower?
Not necessarily lower than 2%, but certainly in the 2% area. We could easily tick above it. You know, we could get towards 2.25. It's interesting at this time of year. You look at everybody's outlooks for 2020, and lots of people are predicting rates much higher. I think they're looking for volatility where volatility doesn't exist. I think the rate environment is going to be benign. I think it's credit where the problems or the volatility will emerge, not necessarily the problems.
Greg, it's interesting. Looking at the bond yield forecast on a Bloomberg terminal, year-end, 193 on a US 10-year, basically in and around where we are right now. But you look at some of the calls out there, SocGen, Standard Chartered, looking for numbers in and around 120, 125 at Citi. Where do you come down on the big rates debate in 2020?
Yeah, I still think it's range bound and sub 2%. And so, you know, we do see a range, a tradable range, but the way I think about it and the way we think about it at PGIM is really quite simply is that the world can't handle higher rates, right? And that's what we learned in 2018. And sure, the Fed was in play and central banks were moving, but real rates moved up, and that was the killer to risk. And so my number one focus for 2020 continues to be the level of real rates. And if real rates move higher, then I think it's a risk-off environment.
So any move higher is self-limiting because any move higher creates a risk-off environment and then the bid comes back in?
Correct.
Is that your thought as well, Diana?
It is my thought, and it's been our call for the last year that every time you get towards that 2% range, you should be buying a little bit of duration, simply because the recovery is extremely fragile. It wouldn't take much to tip us back to growth fears again. And then also, let's not forget, the rest of the world rates are in negative territory, and that demand for duration remains very well anchored.
If that story and that dynamic is true of Treasuries, what does it mean, Greg, for bonds, for JGPs? Same story?
I think it's a little different in a way that you have an ECB in transition. But absent that, yes. But I guess the fly in the ointment is that the ECB is recalibrating, rethinking the strategy going forward, and I think that adds risk premium into the curve across Europe.
Let's talk about the shape of the curve here in the United States. We inverted last summer. We started to steepen into the back end of 2019. How do you see that materializing in 2020, Greg?
I still believe the bias for the curve is to flatten, not to steepen. It points back to this real rate argument. But basically, when rates move higher, there's a bid for U.S. assets, and I think it pulls it down. So it's not representative of a decline in economic growth or anything like that. It's more of just a need, right? And to the point where there's negative rates everywhere else, the higher it is above zero relative, the more attractive it is.
Let's build on this, Andy. Your thoughts on how much steeper this curve can actually get in the United States? We had some steepness come through into 2020. Do you think that can continue?
I think it can continue to a degree based off domestic factors. But as Greg says, as soon as you get any reasonable yield anywhere, people pounce on it, which limits the move higher. I think that it makes some sense to have a steeper US curve because ultimately I think you need to price in the risk of inflation picking up, you need to price in the risk of perhaps further issuance at the longer end if the Treasury decides to shift there. But to Greg's point, I think things are going to be limited because people continue to buy the US market in the absence of anything else worth buying.
Greg, how important has the balance sheet operation at the front end of the yield curve been for some of the dynamics we're discussing at the moment?
I think it's critically important, right? And so the big hiccup that we had in the market, the thing I was really concerned about going into year end that the Fed alleviated was really what's going on in funding, right? And have a well-functioning funding market is critically important to fixed income and the movement of capital. So the fact that the Fed has stepped in, there's still more work to do, but injecting kind of that front-end program has been really important. So I expect that to continue until there's other fixes.
Do you think we've addressed some of those funding issues to the point that they can begin to think about backing away again?
I think it's too premature for that. They have to lay out a roadmap, and there's other things that are beyond their control and much more difficult just from the regulatory standpoint.
Because
the fact that banks are penalized to own treasuries is something that maybe should be altered.
Well, Greg, the kind of thing that I'm trying to think about through 2020 is to what extent the Fed will be backed into a corner with the balance sheet, that they'll find it very, very difficult to back away from the kind of operations they're conducting at the moment. Even if the issues in front of them are addressed, they'll be left with a separate issue that we have a market now in some areas. Many viewers that watch this program will disagree, but in some areas believe this is QE. And because they believe it's QE, they're bidding up risk assets. Then if the Federal Reserve starts to say, you know what, we've solved some of the issues in funding markets, we'll back away from some of these operations, then what happens if you start to see a sell-off in risk assets as the balance sheet starts to go the other way again? What do they do?
No, well, it is a conundrum, and I do think it's really difficult for them to get out, right? And I think that's going back to the ECB experience where they feel trapped, and the same with the BOJ. So the Fed doesn't necessarily want to be trapped, but I think they are. But this isn't QE, it just looks and feels like QE. And the difference is that there's no duration to it, and so it doesn't have the same kind of impact. But there's also talk in some circles on how they're going to help funding by going out the curve, which is decidedly QE.
Diana, final word on that?
I think it certainly trades like QE. It's, I get the point on duration not being bought, maybe not anchoring the yield curve, but the amount of reserves in the system is increasing. The Fed is increasing liquidity, and that is the QE-like impact we're seeing in equities, in risk assets across the board. So I do feel at the point where the Fed stopped doing this might be a little bit tricky for markets to maneuver this year.